Thanks indeed for joining in, taking time out of your schedule to be part of this today's webinar. Now, at Almus, we specialize in managing currency, commodity, and interest rate risk for the clients. And I always tell this to my partner, Vish. SVB had engaged us to manage their interest rate risk. So with today's webinar, one of the things that I really want to sort of, at the end of the financial year, want to make an announcement. Today is the first in the series of the knowledge seminar or the knowledge webinar that we are initiating. And this will be more of, with the intention to spread and share the knowledge on the so-called complex financial market. The whole idea is that every market participant gets an access, understands in a very simple way, and apply them in their own life, in their own decision-making process. The whole idea is to actually share in a very simplistic manner, easy to understand, and basis which the way this webinar is designed is into two formats. The first one, where I'll be covering on the topic related to the banking crisis, SVB, in a very, very simple manner, what really went wrong. And I'll take maybe about 5 to 10 minutes. And post which, I will invite speaker of the day, who's an expert in the field, to share his insights. And he's joining us from London, and he has his hands on almost all the asset class. And we will get to hear from him the insights about the financial market, what to really look forward to, basis which what really has happened in the last 2 weeks. So that's really the format of the session. We plan to cover the whole of it in about 45 minutes, with me about 10 minutes, and then I'll have a conversation with Arvind for the next half an hour. And we have a chat box, so everyone can feel free to put their questions on the chat box. I'll pick it up. We will anyway allocate the last 10 to 15 minutes for a specific question that you may have. In case if you want to really unmute yourself, you can raise your hands and we will unmute from here and you can interact. So that's really the format. I'm going to coin this entire knowledge series as ABCD of financial market. And why I call it ABCD is anybody can decode the financial market with a very simplistic tool. So let me begin by really looking at what went wrong into the SVB. And we are talking about, I guess it was 10th of March when we had the news, Silicon Valley Bank collapsed. And I'm going to kind of go back to the schools as a student of economics. And let me connect to, over the weekend, what really happened in terms of, a group of friends, my own school friends. We were just traveling to Pune and we were in a car and they are all chartered accountants. And they had some very basic questions about what really went wrong. And that's what I realized that, can I put this across into a very, very simple manner, going back to what the banking is all about, what kind of an inherent risk which any banking or any institution carries, and what really happened in case of an SVB. And then we'll really look at the larger impact on the financial market. So let me now just share a couple of slides just to showcase what really went wrong when it comes to an SVB collapse. And as we all know, banking is all about taking deposits and lending to the borrowers. And as far as the banks are concerned, the margin that they make, which is nothing but an interest rate differential between what they pay to depositors and what they collect from the borrowers, is their net interest income. So that's an NII as we call it. Now, banks are in the business of taking deposit and giving the loan. Naturally, the risk that they end up taking is the credit risk. That the money that I'm lending it to the borrower is a safe borrower, in basis which I will charge the credit risk or premium. So banks' margin is the risk which they are taking is nothing but the interest rate, which nothing but is the differential between what they pay to the depositors and what they collect from the borrowers. Now that's a very simple business to do in terms of the years of banking operation that we all are familiar with. But in this process, there are two inherent risks which any banks end up taking. The first one is the maturity profile of the depositors. And what I mean by maturity profile, my depositors can keep the money with the bank for 1 day, 1 month, 1 year, 10 years. Likewise, as a bank, I may lend money to my borrowers. Could be for a short dated, maybe 3 months, 6 months. It could be a working capital loan, or it could be a very long-term loans, which could be even 5 years and 10 years. Or I can even invest these funds into a bond or the security, which could be for different maturity. Now, the key here is managing the mismatch of the maturity between the depositor and the borrowers or my investment book. Now, this is one key risk. If there is any mismatch, surely a bank will end up into a problem in terms of managing the liquidity. So imagine you have a depositors which will want their money back. They withdraw the funds, which are very short dated. And here my entire book is parked in, let's say, 5 years or 10 years. I will have to liquidate this. It's like you breaking your FD to meet your short-term needs. Now that really creates a mismatch in the liquidity. So that's one risk. Let me come to the second risk. The second risk is the interest rate. Interest rates are floating. I can have my book, I can have my portfolio of depositors where I may end up paying them on a floating rate, and equally I can charge my borrowers a floating rate, no risk, as long as there is a maturity and there is an interest rate profile which is identical. But if there is any mismatch there definitely lies a risk, because interest rates in the last 1 year has really gone up. And if you relate this with what happened in case of an SVB, is in the entire period during pandemic, and as you can see between 2020, 21 and 22, SVB collected deposits. Now this collection of deposit, if you really look at the increase in the size of the overall deposits, is phenomenal. From $101 billion, it shot up to $190 almost billion. Now this increase in deposits, banks did not invest by way of giving the loans to the borrowers. Rather, in case of an SVB, one very peculiar thing and very unique about banks, and which is so for most of the banks in US, which operates into this region, is the loan to deposit ratio is very low. So in fact, bank did not lose money out of the bad credit risk. Rather, the bank invested these funds into the long dated securities. And that is supposed to be one of the safest instruments. And I'm talking about 1.5 years back when the interest rates were very low, 1.5%. So all that bank did, that the money that they collected from the deposit holders, they parked it into a safe government security. Naturally, the question will be, why will there be any risk if I'm parking my money with the safest institution? And there comes the high inflation regime. There comes the high interest rate scenario. The Fed kept increasing the interest rates. And in the last 1 year, all that we have seen is a phenomenal pace of increase in the interest rates, which probably in the last 10 to 15 years remained stagnant. And naturally, the money which was parked in the investment, which is for 2 years, 5 years, and 10 years GSEC or the bonds, really started bleeding. And on the other side, depositors were really free to take the money and withdraw the funds from the bank. Now, in good old days, as we call it, the run on the bank, you will see the line on the street. And that would indicate that there is a run on the bank, because every depositor wants to really withdraw their funds from the bank. In the good new days, there is no line that is required. All that you can do is flip your funds between the banks through an app, through a net banking. And that really resulted into the humongous amount of outflow, because SVB continued to offer them 1.5%, where the market had already gone up to 4.5-5%. And naturally, as a depositor, you would want to take money from a low interest rate paying instrument and invest into a higher interest rate, could be a money market or could be other institution. So there was a pressure on SVB to meet the liquidity requirement in a very short term. All that they had to do it was liquidate their long-term assets at a loss, because interest rates have gone up from 1% to 4.5-5%, and do this entire liquidation at a loss up to a point till they said, look, enough is enough. And that's where what happened. I mean, we have seen the entire FDIC coming into picture, the Federal Reserves acting, even the US banks, US government being very active. So all of that is what we are going to cover in the next session. But the key here is that, is it only SVB? Because if this can happen to one bank, probably there are many such banks which are undergoing this kind of a mismatch. It could be an interest rate mismatch, it could be a maturity mismatch. And what really is the scenario? And all of us have been reading a lot of articles, a lot of news items, and that's what is really making the whole financial market development a very, very interesting place right now. Because we have seen an entire decade of low interest rate regime, and currently what we are faced with is the two key things: the high inflation, which is leading to increase in the interest rates, which is where we call it a price stability, because that's really the focus of the government and the central bank is. On the other side, the more interest rate hike that I do, that leads to a financial instability, as we have seen it in case of one institution. So that's really the balancing act that we are faced with. And to talk more on it, I'm going to now invite the expert, the speaker of the day, and indeed a pleasure to have Arvind with us today. And Arvind is joining us from London. Thank you very much, Arvind. And I'm going to just, yeah. So, and I'll just quickly talk about Arvind, a very dear friend. He shares his insights. Rather, he's a unique expert in the field that he has his hands on almost all the asset class. In fact, as a chief investment officer of Q India UK Limited, he has been instrumental in setting up the first open-ended India bond funds for foreign investors. I would rather also call him as an India brand ambassador, who really guides the foreign institutions in their India asset allocations. Brings along with him almost 20 plus, and indeed brings a very, very rich experience. So today in session, we are really going to talk about what really is the situation out there, and how do we go from here in terms of the future outlook, and yep, that's about it. So yes, thanks, Arvind, and welcome on board. Over to you to share your insights on what's happening in the market.
Maulik, thank you so much. I think it's I've been following through Pankaj and through Almas, and I've seen what you guys are doing, and I think investment is essentially a function of risk, right? If you manage risk to be able to deliver and get certain returns, and it could be differing scales in terms of what returns do you need, but essentially if you figure out the risks that you want to take, and of course in today's markets, and when you speak about forex and interest rates, it's mostly about market rates. So the risks comes from market volatility, interest rates, FX. But risk can be so much else, like like when we manage money in Indian equities, the biggest risk that we worry about is governance. Right? Are we investing in certain corporates where we find that their related party transactions or their governance structures or their boards or their management is not aligned to what a minority shareholder or a long-term shareholder wants, and so that risk can never be quantified in terms of standard deviation. It's only after the fact, but before you invest. So so risk management is extremely important. It's become very mathematical in approach in terms of way people think about risk, but it can be as simple as what I said, and we call it smell test in real estate, and when we do equities, we call it shake hands and get your 5 fingers back. If you've got your 5 fingers back, invest in that company. If you do not, then just avoid that company, irrespective of how big, large they are. So there are various ways how people think about risk, but if you do not think about risk and you have unexpected assumptions of what returns could be, you will mostly end up in a problem. So if you know the risk and then you know what returns you can generate by taking that risk, you should be okay. But if you do not think about risk, then God help you in some sense in most cases.
Yeah, yeah. So I think very interesting piece is in this case, as we all have seen it, most of the people knew the risk or probably had an idea about the interest is really going up.
Yeah.
And when we talk about the collapse in the banking institution where we are, and in spite of all of that, and in fact, I'm actually asked this question quite often that this was very simple to guess, right? Because all of us knew inflation is there. All of us knew that interest is going to go up. How come an institution like SVB or many such banks do not manage their core risk? How do you react to that?
I think it was in 2013, and I was in a conference and I met the ex-chairman of LIC, and this was just after taper tantrum. And he was mentioning that this is the first time LIC realized that there are market risks on buying government bonds. Right? Many people realize that in India as well at about that time, because, and so you will always worry about credit risk, but interest rates can, as you showed in your slides, interest rates can also have enough risks in your book. Then if you do not manage it, or if you're not aware of or cognizant of that fact, then it can have a big issue. Now, in 2013, the Indian Central Bank in July 2013 increased interest rates by 300 basis points in one day. Right? Short-term rates went to double digits. Long-term rates went up by 150, 200 basis points. And that has an impact, right? As interest rates go up, you do suffer losses on your bond portfolio. Now, the regulators can withstand it, give you regulatory dispensation, allow you to recognize the mark to market on a later days, or on the future period. But these are risks that you need to worry about. And so if you look at that chart, was interesting because their SVB deposits went from 60 billion to 180 billion. That's like a 300 times increase in their deposit base. And if I believe correctly, their business model is basically venture funding, right? They do funding for startups, either as equity or as debt. And that amount of deposits coming to them in a very short period of time, maybe the risk management suffered at that time, saying that they would have done venture startup investment, which is what they understand very well, and they've done it for many years, and they've been a very successful startup, Silicon Valley startup bank. But because they had such large deposits, and they just went and took what we will believe is the most risk-free asset, which is government bonds and treasuries and mortgage-backed securities. And then they found out that that's so it could well be that expertise on something, or just a lackadaisical attitude towards a product which you do not understand, can also have risks. And that is something that people should understand, that everything that you invest in will have some risks. Even fixed deposits have risk. Liquid funds have risk, as we found out in 2018-19, where Indian liquid funds blew up, right? So everything has risks, and there is a measure to how you can avoid certain risks and how we can manage certain risks.
So in terms of the risk that currently is unfolding, because obviously there is a question in terms of how come the banks fail to understand and take care of the risk. Even the regulators, there are questions on the regulators. There is a separate report by FDIC which estimates almost 670 odd billion dollars of loss on a 2 trillion plus securities. Now looking at all of that is the real key questions that today, on one hand, you have an inflation to deal with, which is what would want you to be at a higher interest rate trajectory. On the other side, you know very well that more interest rate hike will further bleed the portfolio.
Right.
How do you really balance this? And what do you see today? Is this really, looking at this, both the extremes, where we are in terms of, is it really a big debt crisis that we are in? Something that we need to worry as a market participants? Are you seeing a Fed taking a different approach moving forward? I mean, what's your take on all of that?
Let me give you a slightly longer perspective in terms of how we got here in the first place. Like because as you know, interest rates have been low for a very long period of time, especially in the developed world, and that's where they are facing the problem that their interest rates, where it's a negative or 0 to 1 or 2%, and today they are north of 3%. the Fed funds rate is closer to 5, and the long bond yields are between 3 and 4%, and that's the challenge. There's been a significant increase. But if you just go back and look at how we got here and why this time is different than what we faced, say, in the previous crisis, which is, I would say, the global financial crisis. And so post the global financial crisis, although the banks got bailed out, the capital was raised. But if you look at between 2010 and 2014-15, there was generally a period of austerity, right? The US credit rating got downgraded in August 2011. The European sovereign bond crisis happened around the same time and continued well into till in 2012, till Draghi made that famous statement of whatever it takes. And so the fiscal impulse was much lower. So the economies were recovering from a very severe financial shock, but there was no fiscal support after a period of time. And that's when central banks got in. Central banks realized that they will have to keep supporting the economy for a lot longer because there is no support coming from fiscal. And you could see that in emerging markets also. By 2012, 2013, countries which had current account deficits, in India including, had that problem that they had to cut down fiscal deficit. If you remember, in India also, we were at 6% fiscal deficit, came down to about 4.5%, then went towards 4% in the next 2-3 years. And this was a global phenomenon. Everybody had to, tighten their belts because the market was demanding that. The market was demanding that if you have high fiscal deficit, high current account deficit, I'll punish you with higher rates or a weak currency. And most of that happened across the world. And so that's when you got those low interest rates, quantitative easing kind of activities, where the central bank was trying to keep interest rates low, push in liquidity, and hope that growth picks up. But around the same time, if you look at from an investment perspective, China had already done a big stimulus post GFC, and they had to redo their balance sheets and slow down their economy as well. And then from 2016, we had multiple shocks, like Trump coming in and having trade wars between China and US. If in that background, if you see investment into hard infrastructure, cross-border manufacturing, has generally went down, right? Investment to GDP across the world saw a decline. Whereas because interest rates were low and liquidity was ample, you could see an impact on asset prices, right? So you had asset price inflation, but you had very low commodity business-led inflation. That changed after COVID, because in COVID, you could see that the fiscal authorities ignored, rightfully so, any worries on debt and supported the economy in a very big manner. And so not did the interest rates come down, but even the fiscal support was very significant. And the modern monetary theory, as people has called it, MMT, was actually correct in this aspect, that when there is a demand for funds and the fiscal wants to spend, the central banks will always support it. And we saw that, right? Most central banks bought government bonds, bailed out, bankrolled the fiscal, and the fiscal authorities could basically spend and revive or support through incomes, through expenditure, through capital expenditure all across. But the flip side of that was, of course, inflation is not only supply side. Initially, we saw an increase in commodity prices. We saw a reduction in goods being moved out, and we saw an increase in prices. But given the fact that the fiscal impulse was so high, so this time, along with low interest rates, high liquidity, and a huge amount of fiscal spending, you saw inflation coming back. And today, if you see globally, although fiscal deficits have come down, but it is still not the main play. It is still not constrained enough to be able to lower demand. In fact, if you look at in the US, the Inflation Reduction Act or the CHIPS Act, US is now at the fiscal level incentivizing investment and manufacturing, which means that they will reduce fiscal deficit from what it was in COVID, but they will still play a very active role in manufacturing and investment. And that has a very significant impact. So if you're a central banker, you know that the fiscal deficit is not going to go down materially to control demand. The only way that you can do is to by raising rates. And that's what we've seen globally, that inflation is well above their long-term averages. And they're using that one tool that they have, which is raising interest rates and reducing liquidity, in the hope that that will lead to lower demand, which will mean lower inflation over a period of time. So this is where we are, and in that period, the reason we are seeing this impact of in the markets is that as I said, the rates are so much more higher than what they were. Plus, apart from the Fed, which actually tried to reduce its balance sheet and increase interest rates between 2012 and 2018, the ECB, the BOJ, the other large central banks have not even done that. So rates have remained low, liquidity has remained high, and they are facing an even bigger shock because their rates have gone from negative to wherever it is in the positive area. In US, you've seen some changes, but still the long-term interest rate over the last 15 years was say 1.5%, 2%, and today we are at 4%. So there is a big difference. Also, monetary policy works well when it is coordinated, right? So after COVID, everything was coordinated. Like, all central banks cut rate, all central banks put in liquidity, all governments put fiscal. And that exits have been different. Like emerging markets started exiting from this low rate, high liquidity environment much earlier than developed markets. And now you're seeing coordinated developed markets reducing. But we have come to a point where there are challenges coming about, as we saw with the SVB episode, that does high interest rates lead to interest rate risk and risk in the balance sheet, and central banks will have to start thinking about whether it's going to impact financial markets, financial stability. So if you look at what the Fed is doing currently, they have three aspects going on. One is keeping rates higher for longer to be able to deal with inflation. Second is a structural effort to reduce their balance sheet size, which is what is called quantitative tightening, where they are selling treasuries to the market, what they had bought in the last many years. And that seems to be ongoing for some time. And the third is the aspect of this financial stability, where certain pockets of the industry or the banking system is facing challenges. And they have providing liquidity as a lender of last resort in some set, as the central bank does, and against collateral. So they're doing all three, and we can discuss about this in terms of which of this is going to break, whether they pause and focus more on the third part, which is financial stability. Will they stop selling treasuries because the markets can no longer absorb at higher rates? And we don't know the answers to this yet, but there are different ways to think about it. And as we go ahead, we can talk about that in detail.
So, see, there are a couple of points that you touched upon, Arvind. And see, I think one of the things that you highlighted was MMT. While I'm definitely going to put this up as a point of debate, that in the hindsight, what we have seen in the last few months and years, while the central banks adopted MMT, and probably that was the right thing to do, and we can debate it out. But in the hindsight, when you really know that some of the issues that you can't handle, which are supposed to be handled at the, the central banks can't be the solution to all the problems, bottom line. And you still end up, picking up those tools, which in the hindsight, as we look today, can be very destructive. I mean, my only counter to your point when you talk about MMT, looking at where we are today, given the choice that you have, will you still resort to such tools? I mean, is it really recommended in the regime that we live in?
No, I just use the term to explain that when the fiscal needs money, the money is available, right? The banks make that available. When do they take that away is the main problem, right? So central banks should have started increasing rates and taking out liquidity back in 2021. And you saw that got delayed, right? And so was the fiscal. The fiscal also spending did not come down to a large extent. So they could see that there are price pressures, interest rates, and inflation going up. And so this is the challenge that people will have, right? So like even if you look at the Fed, they hiked in March 2022. That was the first hike, if I remember. And but they knew the inflation problem back in October 21, 22, like in September, October 21. But they first had to start this thing of reducing the balance sheet, selling quantitative tightening, and then hike interest rates, right? So because they were still buying then, their quantitative easing program was continuing till late 2021. So they had to stop that and then go into interest rates and then do QT. So, that's where they got delayed, right? If you pick one reason why they delayed because they were still buying these. Like if you look at the RBI, they stopped the GSAP, in that middle quarter of 2021, and then after that, they started thinking about and doing rate hikes, right? So you could see that happening. Markets were already started pricing in saying that rates are going to go up, right? You could see that in the longer end bond yields. It didn't go in the shorter end, but the longer end bond yields globally had moved up in 21 and then of course in 22. But because central banks waited and governments did not control inflation in some sense, you could see that they had a lot of catch up to do, which is why they had to shock the market. Like the RBI shocked the market in May, right? It's suddenly coming out and intermeeting hike of 25-50 basis points, and the Fed had to do the same.
So just to understand one of the other points that you talked about, reducing the balance sheet size.
Yeah.
All of us know that in the last few months they have been actually reducing the balance sheet size. We saw a reduction of almost $600 billion.
Correct.
And in the last few weeks, suddenly we are seeing a jump up to the balance sheet size by about $300 billion or through a discount window or many other measures. So how do you really handle this situation? I mean, is this the common question to any market participants? Would you term this as a quantitative easing, or is it something different?
No. The quantitative easing as we know it was basically buying of longer dated assets in what was called large scale asset purchases, LSAPs here. So they were buying treasuries, longer dated, 10-year, 30-year, with the hope that long-term interest rates go down. And which would mean that, so if I'm a bank or I'm an investor and I get 2% on my long-term interest rate, but I'm a pension fund and I need 4-5% on my return liabilities, I have to move away from treasuries and go and lend and take risk. That's what they wanted with QE. They overdid it, of course, but that was the idea because they had gone to the lower bound of zero interest rates. And the only other way they could have influenced the market behavior is by reducing long-term interest rates. And we saw the impact of that, right? We saw the impact in asset prices, real estate, infrastructure. Today, in that period, in the last 10 years, long-term infrastructure was getting built at 6-7% dollar returns. Ask someone whether you will fund a 20-year road project in the US at 6% dollar. They'll say, go take a hike. I'm getting 4.5% on my bank deposit. But it did that. It flew money into private equity, into private debt, right? These were the agencies which got that money. It didn't get into manufacturing. That money did not get a large into investment, right? Globally, we saw that. But what they're doing currently with this discount window is very different. They are giving a line of credit for survival for certain banks, right? Certain banks, they have treasury. So it's not that they have bad loans. So this is very different from 2007, where the asset side of the balance sheet then was either bad home loans or very complicated, illiquid, structured products. If you remember asset-backed commercial papers, structured investment vehicles, which were basically doing borrowing short and doing risky, illiquid corporate credit, right? CLOs, we don't have that. I don't think the asset side has that kind of a problem today. You still have leveraged loans because of low interest rates, and that will be a problem later. But today you have interest rate risk. That you have bonds you bought at say 9,800 and it's valued at 88 or 90 rupees because you've lost money because interest rates have gone up, and you are seeing a deposit withdrawal, right? Banking and finance at all times is a function of confidence, right? If you have confidence, if people have confidence in your bank or in your business, then they will not redeem money because no bank can meet 100% deposit withdrawal. Absolutely no. Even State Bank of India cannot do it, right? But the question is, in public sector banks, you have the confidence that the government will do something. I will never be, so I don't need to panic and withdraw money. Whereas in a private bank, in today's world of social media, it can go around very quickly. Right? We saw that in 2018 in Indian NBFCs and small banks as well. And so that is a problem. And so those entities have to now meet redemptions, depositor redemptions, but do not have liquid assets. But if they sell it, they have such a huge capital loss that they'll again have more deposit withdrawals. So the Fed has come in and said that here is a liquidity line. You don't sell me that bond at 88. I will buy that bond at 100 and I'll give you money against it and we'll see when you return it back. Right. So Fed has taken that interest rate risk on their balance sheet. So it's very, very different than QE. So you can see Fed balance sheets go up. It could also be because of reverse repos. Right. Today, you're getting so much of money is moving out of deposits and going into money market mutual funds. If the money market mutual funds also are risk averse, what are they going to do? They're going to just go park the money in reverse repos with the Fed and the rate is attractive at 5%. So that could also be a reason why you can see that way. So it's very, very different. I think the scenario is very different in terms of asset quality problem, and the liquidity situation is very different.
So let's come to address the elephant in the room in terms of typically whenever there is a crisis, Fed comes in, bails them out. We have seen it in the past. We have seen a very, very old textbook style playbook. You can anticipate the results, but this time there's definitely one worry that the market participants will have. Most of maybe complacent that yes, eventually things will settle. We have seen a bit of a calmness in the last couple of days. Are we really in for a different regime? Is there really some crisis which is reaching its tipping point? And that's really the question that every one of us have in the room. What's your take on it?
It's as I said, investing is a function of risk and is a function of probability, right? You make probability assessments of what you think will happen and then position accordingly. If you interest rates by itself, high interest rates by itself should not be such a big crisis problem, right? Take an example of this bank's interest rate risk problem, right? If that is such a big problem that it is going to destroy the entire financial system, the Fed will just come and say no mark to market. For example, I'm just giving you a hypothetical. India's done it, right? India said SLR is 19%, but since you bought bonds and you're going to and rates are going to go up, HTM is now 24%, going down 19%. All banks have it. Fed also has HTM, but if this is such a big issue or that will threaten the entire financial system, I think the regulators will come and give some dispensation, right? If you think of it from that perspective. High interest rates generally also, if you look at corporate investment, right? I don't think interest rates matter as much. Of course, it matters, but does not matter as if you have a great investing avenue, long-term capex or infrastructure, which is going to deliver X amount of IRR. Just interest rates will not jeopardize it, right? So, of course, you would have loved to build it at 2%, but at 6% also, if it is relative enough, and the price of that product will go up, right? Interest rates will cause that. And once it happens, then even that's okay. Look at households, right? If households who have savings and if real rates, interest rates remain positive, high nominal rates are actually good, right? Today, if you're in the US, if you were getting 0% on your bank deposit rate and now you're getting 4%, there is some benefit to it, right? There is a very different behavior that you have when you see that, and you will want to put more money back into deposits or money market funds as compared to, say, doing some other risky investment. So the risk that I see are two. One is government. Today, you have governments which have very high fiscal deficit, right? And the debt to GDP across governments is very, very high. And they will have a problem there because so not on their existing borrowing. So existing borrowing is already borrowed, but whatever they borrow incrementally in the next 5-10 years, and if rates remain high, then the fiscal cost of servicing those bonds is going to be high, which will mean that their ability to spend and create growth will be limited because they will have interest burden. The same thing is on corporates. Like, look at what US companies did with low interest rates, buybacks. So they didn't need debt. Like Apple did not need debt, but Apple took debt to buy back shares. I don't think any corporate will raise money at 5% and do a buyback of shares, right? So these will have their impacts. Like if buybacks were a big reason why the NASDAQ 100 did so much well than then you will have to start thinking, right? If low interest rates were the reason why so much money went into private equity and venture capital, including into India, and if rates are today at 5%, then is that an impact? So I think we have to think from that perspective. I don't have a great insight on whether it's, as Rubini will say, doom and gloom, right? I mean, there is always doom and gloom, but I always go back to saying that, if you look at just look at the US, they've created problems, they have problems, but they also have solutions. Like they have institutions in the market today to buy out some of these failing banks, right? So if they clear out, say 10 or 12 of these failing banks, and they have like Warren Buffett will come and write a check, right? Or distressed funds will do it, or funds will do it, right? There are different agencies, or the existing large banks can buy out, which is what happened in 2007.
But I mean, in all this, we are not still addressing the core issue of debt. End of the day, we are at a high debt regime.
Right.
We are talking about a mother of all the debt crisis.
Right.
So eventually, this debt has to get settled, right? Anyone who writes a check doesn't matter. Eventually, where will this lead to?
So right now, if you look at US, the debt is in the government books.
Yeah.
If you look at Japan, the debt is in the government books. If you look at China, the debt is in corporates. Right? If in India, government, largely government, right? We corporate sector. So is the government better off in managing a debt problem than a corporate? Of course, yes. But can they do it? Can all governments do it? No. So that's why you will have, some governments will find it very difficult to operate at a particular level of debt because the market will just stop financing it. Right?
Yeah, because you already talked about the trust and the confidence. Then really the question will be, will you now trust in the today's regime, the US government, or for that matter, all the Western central bankers with the level of debt that they carry?
So central banks have a particular issue. Like, I think the interest rate risk that we talked about of high interest is largest in central bank balance sheets.
Yeah.
Right? All central banks have bought long-term bonds at lower than what it was, right? Even the RBI bought below 6% or 6.5%, and the rates are at 7.5%. The US bought at 1 and 2, and the rates are at 4.5%. So certain central banks will have to depend on their fiscal government to bail them out, or they will give less dividends. Like RBI will surely, I don't think there'll be any dividends going out from the RBI to the government this year, because there will be huge mark-to-market losses on not only on the domestic book, but forex reserves as well.
Absolutely.
So China also has forex reserves. They're invested in treasuries, and they will have a mark-to-market impact. So you will see those impacts coming about. Whether it will lead to a huge crisis, I don't know. Maybe I'm a bit naive to answer that. I don't know whether that debt. See, debt to GDP is a stock. GDP is a flow number, right? So debt to GDP itself is not a correct way to see it. When you see debt to GDP going at 250, 300 times, that's when you come up with debt service coverage, right? How will you cover your debt? But at 100% of GDP, it seems to be okay, right?
See, I'm just sort of trying to couple it with some of the other geopolitical development that is happening. Eventually, you can keep floating the new debt as long as you have a buyer for it. Now, with today's regime, and I'm now connecting this point to the de-dollarization. I mean, what we have seen in the last few months, rather, individual country block, currency block getting formed. We are talking about a central bank diversifying their reserves.
Yes.
We are also talking about a trade block getting formed.
Correct.
Now, all of it, as long as you have a $1 currency, which is a world reserve currency, you can keep printing, and you will be sure that eventually you will have a buyer for your debt. Question really is, in the current regime, is that really a question? If not, then where are we leading to? I mean, are we really looking at the long-term debt crisis and impacting further the dollar as a reserve currency?
If you look at dollar as a reserve currency, the reason, of course, they took the ample, and they took the benefit of the financial system in the 1940s after World War, and they became the financial economy of the world. And then, of course, dollar became that. But one major reason why that happens is that if you look at the balance of payment, which is current account deficit and capital flows, at the end has to balance, right? So if it has to balance at the country level, it has to balance at the global level also. So countries which run current account or capital account deficits, need capital flows. So the US, India typically are countries which run current account deficits and then drag in capital flows. So in the US, the capital flows is largely, say, treasuries, which is foreign central banks buying US treasury. In India, it is FDI, foreign portfolio, private equity, venture, right? So for a global block to emerge, like from a de-dollarization, like will people invest less in dollars? Of course, they will. Like it has happened, right? Say that before the euro, the US had a much higher share of the global trade world forex reserves, and after the euro, it has gone down. And maybe as China becomes a bigger part, maybe it will go down further. So if Saudi and China deal in RMB as compared to dollars, maybe that they so the thing is now, so if Saudi Arabia is exporting oil to China and does not import as much, right? Right. So they get RMB. Now they should be willing to own RMB as part of their forex reserves. To what extent will they do it? We don't know. But they will do. They will go and buy Chinese. Now, how much can you depend on Chinese assets? Right. I think you can depend a lot on Chinese government bonds. But Chinese equity market, as you saw what happened in 2020, 21, suddenly it's a communist regime, right? They can just change the rules of the game anytime, and you have no say on what they do. So Chinese government bonds, maybe Russia and Saudi Arabia might be able to own, but what other assets can they own, right? And China themselves runs a very large trade deal. They don't run as much because, but they still have a trade surplus. So how will that balance? I think you have to think it from that perspective. Of course, the usage of dollar will go down as larger countries or as commodity trading partners start trading against each other. Does China also want to run? Does China want to become a reserve currency? I don't think so. Like they haven't said anything about it. And the one time that they used their forex reserves to able to have influence, which is basically all the Belt and Road, and they gave money. They are in trouble. They've lent to countries and economies where they are not getting the capital back. Sri Lanka is an example. Africa, many countries. So that it's a larger point in terms of whether this digitalism will take place. Of course, it will go down, but do people want to own a non-dollar asset as part of their forex reserves, as part of their investment portfolio? That jury is still out.
Yeah, I mean, we already have seen a shift in the dollar reserves for the central banks from 70 odd to 58 now.
Correct.
The question really is whether that will happen on the trade front, and connecting that to a point where even Indian government had this circular in the month of July 2022 where they allowed the imports and exports to be traded in rupee, though it has not really started, and for the reason that you also talked about, that end of the day India has a deficit with most of the countries. And when you have a currency, your own currency lying with the foreign trading partners, where do they deploy funds? Would they be comfortable owning the Indian asset versus, owning a dollar? So that's really as a question. But of course, the critical point, which most of the participants also would be interested in, are we then looking at, I mean, in the backdrop of whatever is being happening, is this really a beginning of a dollar weakness cycle? Because we talked about eventually interest rate, if that is leading to a crisis, then you can always see an interest rate cut. And we have seen the dollar gaining in the last 1 year, mainly because of the interest rates hike. So are we now looking at, given there is a financial stability which may take the center stage, and if there is a dollar pause or a cut, will that really impact on the currency world, a weakness in dollar, and especially for the emerging currency like India, a strength in the currency? I mean, just what's your view on that?
Yeah, I think if I look at long-term cycles, we generally get this 8 to 12 year cycles of dollar strength and weakness. Like if I see from a trend perspective, and I think emerging markets will rightly claim that there is a need for a dollar weakening cycle, because if you look at EM currencies in the last 10 years have had a big problem against the dollar. Right? They've just weakened so much against the dollar because the dollar has been strong. The dollar is strong for many reasons, right? Purely that this is just a regulatory ability of US to bounce back from each crisis, and hence the trust that people have in banking. Plus the way the Fed is able to react, right? The technically the ECB has still not resolved the sovereign debt and banking crisis that happened in 2011-12. And we saw Credit Suisse and Deutsche Bank as one aspect of that, which is a continuing thing. Whereas the US has cleaned up the balance sheet, put regulations, take an interest is up, take an down, put liquidity, take out liquidity. They're far more dynamic in that perspective. I think if given the fact that I think this inflation is not a. I was in the US last week and last month, and I could only see vacancy boards. The employment situation is still reasonably strong across all segments. You could see that in companies, and you could see that in retail shops as well, right? And you could see a lot more construction activity, which I have not seen in the US. So which means that they will have to keep rates positive. So that is a issue where I'm not able to grapple, in the sense that if US interest rates remain high, why should the dollar depreciate, or why should the dollar weaken? You've already seen some of it, but is that be a structural thing? I don't know. The way the dollar weaken is if the US with these interest rates is able to keep its growth high, which would mean that it will have current account deficits. Right? The moment the US economy grows, they run current account deficits. Right? That could be a reason why the dollar can decline. So rates can remain high, but because the economy is doing well and inflation is controlled, the current account deficits will kind of lead to a dollar weakness. So that I think the jury is out, because we still don't know whether the US can withstand 4.5% interest rates today and not have a recession and not have an inflation problem. So I still think that the Fed is not anywhere close to cutting rates, right? What they will do is pause, and they will hope for the inflation to come back to its rate, because in the US, the inflation is a political problem. It is not an economic problem. When inflation goes up, it becomes a political issue, and the elections are coming very close next year. Right? So I think they will keep rates longer unless they see a huge destruction in the banking system, which I don't foresee. I don't see that.
So I mean, in fact, I was about to ask that question. So given that you foresee the rate to remain where it is, you don't foresee this current crisis to really continue for a long?
No, as I said, the central banks have the ability to control it, right? Within a day, they came out and put out the liquidity window, which should solve. If somebody is facing a deposit withdrawal because they can't sell their treasuries, they can solve it. They will have to worry about some other contagion, in the sense that if you see stock prices, people will react to seeing stock prices of banks falling and then go and redeem money from other banks. I think if they get two more, like I think somebody bought Silicon Valley Bank, right? First Citizen Bank. If we get three more transactions like that, where the large entities coming out and buying those troubled banks, I think they can. I will find it very difficult to believe that US allowed a interest rate risk problem to become a financial system stability problem. I think that is. So I think they would have really failed in their duties if they get into that situation.
Yeah, maybe it looks like it is an interest rate problem, but as like you already mentioned about Dr. Doom Robini, who says that we avoided the debt crisis a couple of times, right? And we have been kicking the can down the road.
Right.
Eventually, we have to face it. Question really is whether it is now or later. And in fact, he's even gone to the extent of talking about that we are actually in a Bermuda Triangle. There is a P&L hit, the income level is very low. There is a liability side risk, there is an asset side risk. I mean, we never had such three problems at a time.
I think we always had this problem. Like all financial crisis is essentially a balance sheet problem, right? You get balance issues in the balance sheet, either a confidence issue on the liabilities or asset quality problem on the asset side, and which complicates the issue. So I think we've had that. We've also seen some debt deflation in the last 10 years. But he's right in the sense that there is a huge debt overhang in the economy, and different countries have different pockets of that problem. Like in India, it is government, as I said. In the US, it is the government. In China, it is the corporates. So how that will play out is I'm not in a position to, but will it lead to slower growth? Yes. It should lead to slower growth.
I mean, are you looking at a stagnation kind scenario? I mean, maybe like several years, it could be like, low growth regime till we really settle down, let the dust settle down. Are you seeing that kind of a scenario in time to come?
It depends on inflation. So if the inflation comes back to about that 2 to 3%, then the fiscal governments will have better ability to continue to spend on growth and continue to take on debt. If that doesn't happen, then there'll be a problem because then the rates will have to go even higher. And that will mean like that will be the 70s, 80s kind of thing where you completely kill growth by high interest rates. And then a recovery time, and it takes a long time to come about. What is different though is the government's commitment. Like as I said, Inflation Reduction Act. If you look at the mechanics and details of it, it is so far reaching in terms of the amount of money that they're going to spend and in the segments and sectors that they're going to spend. And it seems as of now, it is irrespective of wherever the inflation is and interest rates are. Right? They will fund. They have not provided in the budget, but they will provide it. But it is a 5-10 year aspect to regain competitiveness in the US from a geopolitical perspective. I mean, those transcend near-term inflation. And so if they are able to do that, and that attracts foreign capital into the US, then the global growth itself will be.
Very interesting. I think that was a very, very interesting take. I have few minutes left still, and I'll open up this for all the participants. In case if they have any questions, they can use either the chat box or raise their hands. We can unmute and you can put up your questions.
We didn't talk about India at all.
Yeah, in fact, we'll just see if there are no questions. Maybe you can touch upon India. And definitely, one is India. The other is where you see eventually, or in whether the funds coming into the country, are you seeing Indian economy being so vibrant that irrespective of what happens in the world out there, we will continue to grow? I think Jaram has raised the hands. If someone, Virendra, just see if you can unmute him so that he can speak up. Yes. Yes, Jaram.
Yeah, hello. Can you hear me?
Yes, sir.
Yes.
Hi. Okay. Good evening and very good presentation by you. Very comprehensive. Yeah. So my question is two questions. One is, as you yourself mentioned, the interest rates in Europe have gone much longer way than in the US. Deep down negative to 3.5% repo rate right now by the ECB. So as we have seen historically, anything that happens in the US repeats in Europe with a time lag. Are we expecting a similar situation in Europe down the road? That's one question. Other thing is, like, in 2021, every day we were counting how many trillions more of zero or negative yielding bonds is the world holding. That is how we used to do. We at one point of time, I think it reached 17 trillion. Now from that level, we have come to 3, 4, 5, whatever the current yields are. And obviously, the losses have got distributed to various. Now, my question is that compared to the banks, whom obviously Fed is supporting very well through liquidity, pension funds and mutual funds hold a lot more of US government debt. Are we seeing a situation of any of these institutions getting into trouble, and how will the authorities address if that happens? Thank you.
On Europe, I think their growth dynamics is a lot weaker and different than the US, right? So the ability of the US, if you leave out the last 15 years, of course, the debt levels have changed, but back in 2007, rates were at 4.5%, and the economy was doing well. They suffered a credit crisis, but the economy actually held up well. And then that was the average, right? The average 10-year US 10-year was at about 3.5-4%. But that has been very different in Europe. So because their growth impulse, the demographics is so much different in Europe, I don't think they will be able to withstand, say, 5% interest rate. So that's why they haven't gone there yet. Your second question was on sorry, I forgot.
Mutual funds and pension funds.
Yeah, pension fund. So if you look at the US pension funds as well, if you look at their asset allocation that they had in, say, 2000 and in 2020, it is widely different. They responded to these low interest rates by putting more money in private assets. So private equity. So as a share of their portfolio, money into private equity, private debt, infrastructure, real assets, real estate went up a lot more as compared to bonds. So I know of certain pension funds which have less than 10% of their money in treasuries. Because why will they own something which is giving them 0 to 2%, right? What will happen? So some which still have a high proportion will face an impact. And that's a larger discussion where many US pension funds are underfunded and they will have to deal with this. But generally, nominal interest rates, higher nominal is actually good. So today you will have a situation where a pension fund, if their return target is say 4.5%, and if they can buy a 10-year investment grade corporate US at say 5.5%, I think they'll be happy to lock in that and sit, as compared to chasing a higher risk avenue, which is say private equity or private debt. So I think that will be the impact. You will see, if rates remain higher for longer, you would see much more money getting cut for illiquid long gestation assets, which is mostly private assets, right? And I think India will also see that, in the sense that if you look at cumulative flows into Indian public equities and private equity from foreigners, public equity is negative. In the last 5 years, I think we've lost about $30 billion net outflows, because India has done so much better relatively. Whereas in private markets, in private equity and Indian venture, I think we've got about $90-100 billion, or maybe more, definitely more, close to $120-130 billion. So, of course, part of it is just India's dynamism, and as India's economy opens up, becomes larger, more companies, more businesses, more sectors get fundable. But it also has a factor of easy money available at low interest rates globally, which is no longer available. So that will have an impact on flows. Maulik, you asked on that, on the aspect of, how are foreign investors looking at. I think generally you will see investors looking at India on a dedicated basis. This is exactly what happened to Korea and Japan in the 70s, 80s, 90s. This is exactly what happened to China in the 2000s, where the economic size and opportunity became large enough for people to have, okay, I need to be in this market. And that goes from FDI, which is companies. So foreign, like Apple coming up and manufacturing in India, is not just China plus one, it is, but also that India has itself a domestic market, which will be large enough and rich enough to be able to afford Apple phones, right? So I think 15-20% of their Apple manufacturing will be for India, and the rest they'll export. Many more companies will see that. And you should see a similar aspect in investors also. Like if you're a pension fund, and if you want to invest in emerging markets, but today, if you look at MSCI emerging market index, 30% is China, right? If you can't invest in China and Russia and Turkey and Brazil, then how do you go allocate and take out that return seeking asset that you want? And that's why they will be forced to look at dedicated allocations. And then if you're doing a 10-15 year investment, I don't think you can't think of India and do it. You have to be in India. But they will have to be cautious in terms of whether they do public, whether they do private, whether they do illiquids, and also the entire governance framework, right? They need to have a lot more confidence on the political system, on democracy, on governance, to ensure that none of those aspects which has helped us in the last 30-40 years change, right? Tax rules change, even I think that has also become slightly more predictable, not in domestic, but for foreign investors, tax rules have not been that badly changed. But these aspects will matter. But I don't see any large investor not thinking about India. They are not investing currently in the way that they should, but they will be thinking about it, and they should think about it.
Got it. So we have overshot our time, but last question before I leave you, and can't stop asking this question: gold as an asset class. What's your take?
I always say to people that the way I think about gold is buy gold and hope that it falls, the price falls, because gold is that asset, right? Gold is a denominator of risk, right? So if you buy, if gold prices are falling, that means the economy is doing well. There is no debt problem. There is no central bank going bust. There are no banks going bust, and you have a job and you have incomes, right? So gold is your risk management insurance. So
gold is a hedge.
Always tell investors, yeah, perfected. We always tell investors that you should have, depending on your risk profile, you should have 5, 10, 15, 20% of your portfolio in gold, and buy it and don't worry about it. It's like you don't question your life insurance, right? Every day when you come back home alive. It's the same with gold. Don't question it. Let it do what it's supposed to be, a portfolio insurance in some sense. It's your hedge against central bank stupidity, government stupidity, political stupidity. And those exist. So you should have gold in your portfolio.
That was a very, very interesting piece on the gold. Though we have been a firm believer of, especially from the Indian side, gold as an investment. I mean,
Yes,
maybe that old thinking actually plays out well. That
right.
this is like
Absolutely.
your always long-term investments. It helps you in the bad times. In a way,
Yes.
that's what exactly you're saying. That you're hedge against
One reason India is, I won't say resilient, and India has its short-term issues. But if you look at Indian asset allocation, people have money in land and house,
Yeah.
right? People have money in fixed deposits, insurance, provident funds, and people have money in gold.
Yeah.
These are much more stable assets. It's illiquid, but gold is not, right? Gold, I think the one reason why people have gold is it's the most liquid asset in our country. You can actually pledge it in a second and get money back.
Yeah.
That
I mean,
also gives one reason for resilience.
30,000 tons translate into almost $1.5–2 trillion.
Absolutely, it's huge.
That's the kind of, it's huge. So great. I think as any investment managers, you are bullish on all the asset class, and at the same time, you have a very strong belief, it seems, on the central government's ability to withstand and take us through this entire so-called crisis which is there in the short term. I mean, that's what I could make out. And at the same time, there are prudent risk management piece which one needs to have it. I could hear some themes emerging, and I'm just picking up that in terms of the US investing into the manufacturing capability. I think that's a very interesting piece that you talked about, because then it may lead to a different kind of opportunity for the diversification into various asset class, including the industries. And at the same time, India, you continue to be bullish. You can't not invest.
I won't say bullish on all asset classes, bullish, but we are optimistic in the sense that long term, you have to be optimistic on India. Short term, they're always follow, and then in every investment that you make, as I said, risk is always a factor, right? So public equity valuations could be a risk. So how do you manage that, right? Inflation in India, food inflation could be a risk, but there are ways and means to manage it. So
sure. Great. Thank you very much, Arvind. Indeed, a pleasure chatting with you. And thank you once again for joining in from London. Indeed, a great pleasure for all of us here at Almus to have you. And on behalf of all the participants who have been there, I think we have seen the numbers remaining steady throughout. That probably speaks about your, you maintaining the interest and the, enthusiasm in the participation. So thank you.
I hope you like it. Thanks.
Yes, very much. And for everyone, as I said earlier, we will continue to have this knowledge series. We will talk about a complex financial topics in a very simple and easy to understand manner. We have the next series, which we are planning to have it on exactly 2 weeks later, which is 11th of April. And on that, we will talk about the balance of payment, especially the India balance of payment, the Indian balance sheet, again, in a way that, all of us can really connect to it, and then we'll decode it. So again, the theme is anybody can understand, can decode the financial market. With that, we'll come up on 11th of April, share the details about the speakers as well. And thank you once again, all of you, for joining in. Thank you, Arvind.
Thank you.